Welcome, everyone. Thanks for joining us for the State of SMB Lending, Reading the Signals in Q1 2026. We are recording this session, and you'll have access to it and have the full replay in your inboxes on Monday morning. We've got a packed agenda, so I want to make sure David and Patrick have all the time they need. With that, I'll hand it over. David, Patrick, over to you.
All right. Thanks, Rana. Good to be here. Thanks, everyone, for listening. I'm David Snitkof. I'm General Manager of Small Business at Ocrolus. I have been at Ocrolus for about 6 years and lead the SMB vertical here, and have been generally applying technology and data to problems of credit in both business and consumer lending for around 20 years. Done this at really big companies, done this at tiny companies that have grown and sold, and really everything else in between. So very excited to talk through some of these trends in small business. At Ocrolus, we have an incredible amount of data on the cash flow, the liquidity, the debt capacity, the seasonality, and general financial health of small businesses. And I think it provides an interesting window into the small business economy and how it relates to economic trends at large.
Thanks, David. To introduce myself, my name is Patrick Shubert. I lead the SMB data science team here at Ocrolus. I joined just about 9 months ago. It's a very exciting role and responsibility. Prior to my time at Ocrolus, I was portfolio manager and in credit analytics and finance at Barclays, at PayPal, exploring the evolving fintech landscape for just over a decade.
All right. So, we've separated these insights into operational insights and financial insights. Of course, they're very tightly linked. So this is not really a hard and fast separation, but in general, just to orient everyone, at Ocrolus, we deal with about 200 different small business lenders and growing. We receive about 500,000 credit applications a month. And for each application, we receive a pretty large amount of time series transactional cash flow data, either through bank statements or digital aggregators like Plaid or Finicity or Decision Logic. With every transaction, we tag the transactions to understand their impact on small business cash flow. We generate a lot of small business analytics, and also because we have so many different businesses that we monitor through our network, we're able to understand how these businesses compare to their peer group, and we can use that to understand some valuable trends. So here we're looking at one relatively simple thing, which is what is the incidence of non-sufficient funds transactions and overdraft transactions on the bank data of people who are currently applying for credit. And we do see that over the past few quarters, this trend has been going down, and that's generally a good thing to see, insofar as businesses seem to be less overextended and operating not quite as close to the margin, and generally having a more responsible approach to their cash flow. Relatively simple trend, but good to see these numbers going down and stabilizing at a lower number than the historical average.
Thanks, David. And just some context on the data that we pulled together to view here. We're looking at a population of about 8.3 million applications over the prior 36 months, which gives us really an excellent perspective or vantage point on what's happening in these SMB lenders. One thing to keep in mind, if these rates look higher than some of you might expect in your portfolios, is we're looking at all applications. So this isn't a funded population. And so obviously the stress that exists outside of your buy box will be represented in a lot of these exhibits or artifacts as we walk through them.
Yeah, and Pat, that's a really good point. And just going back to NSFs and overdrafts for a moment, this is, if you have more experience in consumer credit than in business. One thing that I know back when I had been doing a lot of consumer credit and I moved to doing more business credit, and I saw some of these numbers, I would always look at them and say, wow, that's a lot of NSFs, that's a lot of overdrafts. Because if you saw these kind of numbers in a consumer portfolio, you would be very surprised. Pat, do you want to talk about some of the just dynamics of a small business and why these rates are naturally higher in the business world than they are in the consumer one?
Absolutely. And I think it's an important point as we look at kind of the data that comes across our network. We see there are a lot of businesses, particularly around the median, from most metrics that manage their income, and where they have excess income in a quarter, they're going to find legitimate business expenses to manage closer to zero. And because they're managing that, whether that's paying the beneficial owners or whether that's investing in the business, you see when compared to consumer credit, a lot more businesses managing closer to a neutral income margin.
Yeah, and I think, also a small business, and of course, this is very different for different types of small businesses. So the financial dynamics at a dry cleaner or a dentist or a law firm or a restaurant are going to be very different. And we do a lot of that when we're looking at our cash flow analytics, the differentiation between different operating models. But in a business, you have such a more diverse and complex set of cash flows and working capital issues that it is easy sometimes for a business owner to make a mistake on the timing of some of these cash flows and end up with an inadvertent overdraft. Doesn't mean the business necessarily has a fundamental liquidity problem, but sometimes just a timing and management problem. And actually, access to short-term working capital is a tool that many businesses use to overcome that obstacle.
Yeah, I think we see it really in our analytics suite. It's one of those things we focus on. There are very common Ocrolus features as part of the cash flow underwriting that look at things like number of days with a negative balance, or we would expect a higher risk signal, once you get to 3 or 4 NSS or even more than that. So I think those familiar with consumer credit would balk with the concept of how many days of negative balance are good, but it is a common dynamic that we see when we're looking at the SMB health.
Yeah. So here's another interesting one. And here we're looking at, different payment methods used for outflows in a business's operations. And here we see a couple interesting things. One, the usage of checks has gone down over time. If we're looking at the past, I think we have 10 quarters here. Usage of checks has gone fairly monotonically down and is now pretty low in terms of, the percentage of businesses who have check activity. On the other side, other merchant services are going up. Pat, what's behind this red merchant services line? What does that really mean?
So you can think of that as your online payment platforms, your Squares, your Etsy's, your Amazons. It can be both marketplaces and financial payment services, and it's shown, I think, a very understandable, consistent growth. But I think it does kind of anchor the thought. So we're seeing adoption here. So you can say close to 90% of all the merchants we see now are engaging via outflow with one of these payment platforms or marketplaces. And conversely, what we're really looking at is the presence of that as a channel in the application. And most applications show around 3 months. So for this to decline, it would mean that that merchant applying hasn't had any of that activity in however many statements that they're submitting for underwriting. And so it can be a little bit of a trailing indicator. I think that it's particularly interesting when you look at things like check usage, and we're doing some exciting analytic work to understand this better and to get a little bit more granular. But that pullback that we see really in 2025 Q2, 2025 Q3, I think there was a narrative about rising costs and that there might be some liquidity pressure on small businesses during that time period. And what we see is that as the checks pull back, that means that for probably on average 3 months, a smaller percentage of businesses were reaching for the checkbook, right? And so while there's kind of a long-term change of state here where digital is going to have a higher and higher adoption rate, you're going to see more merchant services. We see credit card use becoming more and more common, though it's been prevalent for the better part of a decade. That pullback in the checking activity suggests that as of 2025 Q2, 2025 Q3, less of the applications that we see over the overall network had any check activity. And that can be a really interesting indicator for liquidity.
Yeah, and as you talk about that, it occurs to me that we didn't show a graph here of check usage by industry, but we have looked at that before. And when you do separate check usage by industry of business, it varies widely. So if you think about a construction contractor, they still do a lot of business by check. but you would never pay your restaurant with a check.
Yeah.
And so payment methods differ very substantially by industry. And that's important to know, especially if you're a lender or another financial services provider working with businesses in different industries. There is just such a different operational profile of the payment tools that someone uses, both on the outflow side and the inflow side. It's also interesting when you're thinking about fraud and anomalous behavior, if you see a pattern of payment rail usage that is atypical for a business of that kind, it could be a prompt to dig in a little more closely.
Especially as we enrich every application with a NAICS category code. And so that's the first segmentation that I'm usually looking at, or one of the first, whether it be a NAIC 2 sector or a NAIC 6 granular view. Um, it We see very, very different operational dynamics, and we're always looking at those. I strongly urge anyone who might want to engage with the data science team or analytics. We can provide much more granular views of these things and really understand the different markets. It also means that mix can have a large impact if you're really aggregating the portfolio, and may not always be the best way to manage from a portfolio strategy. Luckily, I will say Ocrolus has a very unique vantage point. As I said, we're looking at 8.3 million applications. So we're capable to see into these things with a sufficient sample size to really distill what we think is evolving in the market.
Yeah, and mix effects are funny. You ask any credit risk person about mix effects. It's kind of like if your electronics aren't working, you just say, "Is it plugged in?"
Yeah.
And if you have a trend in your portfolio you don't understand, I think the first question should often be like, "Wait, is it just a composition effect?" More on that later. Let's talk about the next trend here. So, if unless you, for some reason, have the presence of mind to switch to electric, a while ago, you have been seeing this as you have filled up your gas-powered car. Fuel prices, of course, have been going up since the beginning of March with the war in the Middle East and a lot of macroeconomic uncertainty. It is somewhat good news. In the past few weeks, they've come down a bit, although they're still far above their historical average. And a lot of small businesses are really sensitive to the increase in fuel prices. So if you look on the next graph or the next slide, what we've done is we've segmented all the businesses we see by how fuel sensitive they are. So we created these tiers, tier 1, 2, 3, and 4, and then a tier for not fuel sensitive businesses. This is based on what percentage of their operating expenses are made up of fuel costs. And what we're looking at in the graph here is the change in application volume in these industries between January and May. What we see is that the biggest impact has been seen in these tier 2 businesses. So these are businesses who are not the most fuel sensitive, but they still are very heavy users of fuel. And these are landscaping businesses, construction businesses, agriculture businesses, even gas stations themselves, where, it's a really big part of their budget. And I think these businesses have delayed a lot of their drawing on capital. They've delayed a lot of their investment. They've delayed some of their decisions because of the uncertainty out there. Interestingly enough, the tier 1 businesses who use even more fuel, these are ones who they use so much fuel, they have probably pre-bought fuel, they've hedged their fuel exposure, or they're in a business like transportation where they've been able to pass along a lot of these cost increases to their customers in the form of pricing. Now, if high fuel prices go on for longer, we may see a lagged impact in tier 1 as well, but this is what we're seeing so far.
It's a really exciting segmentation. I think the first time you showed this to me, David, it counter indicates to the surface level heuristic you might have, where you say, oh, those who are most exposed should suffer the most. But it totally makes sense in terms of these businesses have the focus to manage that, whether it's being fleet operations or hedging. We hear in the trucking industry, it really aligns, and that tells me that this is working exactly the way it should, and it's worth something tracking over time, both from an application or origination quality standpoint and from a performance and delinquency standpoint.
Yeah, and then just as you mentioned that, I'm thinking of one more point. We didn't show this graph in here. But actually, if anyone who's listening wants to see this graph, send me a note and I'll send you the graph. These tier one businesses that tend to be larger also are the ones who tend to have more access to bank credit than the others. And we have seen in our data a greater propensity to draw on bank credit among these larger businesses that have access to it. Many of the others don't have access to bank credit. And for some of them, they've actually been delaying investment because of that. Let's go to the next slides. But because, one, what we just looked at was on the, application side and the desire to grow. I think all other things being equal, you also see a similar impact to these tier two businesses in terms of their delinquency rates. Now, to the comments a couple minutes ago about mix effects, there's a lot of other things that could go on in terms of delinquency. So this is really, this is not absolute delinquency, this is relative delinquency, and this is saying holding everything else equal. But if you look at these tier two businesses, the delinquency rates that we're observing would indicate those are the ones who are currently most financially stressed.
Moving into financial performance, Ocrolus does a great deal to give underwriters the ability to look into both risk signals, but also the overall performance, kind of from a P&L standpoint, the volatility of that. So we wanted to make sure to put in front of this audience what we're seeing, and we can start at debt service coverage ratio, right? Ability to pay is always kind of a foundational data element we're trying to understand when we're making underwriting or credit risk decisions. And so calling back to the population and how this cohort was constructed, you can think of the 75th percentile, both from a revenue standpoint and a DSCR standpoint, as kind of the floor of the buy box, somewhere near there, or the credit box. And the reason I say that is we're looking at 8.3 million applications, 36 months, and we know that most of our client feedback is that origination or approval, full approval rates are somewhere between 20 and 30% of the population, and DSCR and revenue, obviously, if you're in the top performance of those, barring other risk indicators or expenses, you're probably, it's a good proxy for the buy box. And so what we saw evolving over Q1 and Q2 here is the gap widening a little bit. And I think this is a positive story for most SMB funders and lenders. That dotted green line representing the top 75th percentile of the debt servicing coverage ratio shows improvement from Q1 to Q2. And the way this is being calculated is we take the total revenue, where Ocrolus tags every single credit coming into that bank statement as revenue, and then we deduct the expenses X debt, so all of the operating costs, and then we divide it by their debt servicing. So all the outflows that we see going to known or derived lenders, whether that's banks or fintechs or revenue agreements. And so what we're getting here is a context of that net income divided by their servicing cost, and we see 5 to 6 and growing in the 75th percentile, very healthy rate and improving. And then we see the stress in the bottom 25th percentile. And I think that this probably matches a lot of the indicators that we've seen over the last 6 months or so, where it appears there's stress on those businesses that were already perhaps underperforming. It does look stable now for 2026 Q1 and Q2. And the median really is as stable as ever. And that calls back to that median population is usually kind of managing to break even and may sit underneath the credit box. But definitely improvement where our credit strategies might kind of bump up against the limit of provability at the 75th percentile. Operating margins, an even clearer view of that. So as I had laid out, the DSCR, or the debt servicing, takes the operating income divided by the servicing cost. So in theory, if we were seeing that the debt outflows were increasing, their debt servicing was increasing, that could affect the rate. So to get even more clear on the net income picture, you can see the same exact trends, which suggest that debt servicing costs are very stable. We see the operating income among the top 75th percentile improving, and we see stress far below our credit buy box. This is a interesting view, and particularly when shown side by side. So kind of how we talked about the adoption of payment rails, so the percentage of merchants where we're identifying specific types of transactions. You can think that that probably represents around, on average, three months of statement history. This is on the left, pointing out how many merchants we see, or the share of merchants that we see that are incurring a payroll cost, a tax cost, an insurance cost, a card cost, a debt service cost. And so I would say these can be a little bit volatile. You're looking at year over year and quarter over quarter, but it's relatively stable. In one way, all roads point back to mix. Payroll and taxes, when we do see those increase as incidents, that's very related to seeing perhaps a higher level of sophistication or a little bit bigger businesses. Obviously, sole props, and there are a lot of small SMB merchants who may not incur a payroll cost. They might, be owner operators. And similar with taxes, they may not have as many. We tag everything from state, local, federal, and also some licensing type costs in here. And so the higher prevalence can be an effective mix. On the right, you can see it by
Are you big
dollar.
enough to pay quarterly taxes or something like that?
Yeah, and there's a timing component too, right? Like in Q2, now luckily we're doing year over year and quarter over quarter. So I'd say the year over year kind of controls for seasonality, but the quarter over quarterly may be caused by kind of a seasonal dynamic, particularly in taxes and insurance, where those things can line up, to quarterly or semi-annual cycles. It is useful to see that card adoption, this aligns really nicely with the earlier view. Card adoption is still up, debt servicing a little bit less, and as a dollar amount, holding flat. So that's what we want to see. We're not seeing, that on the dollar amounts, obviously there's inflation over 12 months. So we would expect to see a little bit of rise here. I think that might be some of the story in taxes and insurance. But we see the debt servicing is very stable, and that's exactly what we would want to see as a healthy indicator. So on that view, as we look longitudinally across the Ocrolus network, one of the really interesting data points going beyond kind of the financial and operational data points and the risk events is something that's fairly new, I think, in the SMB space. Those who have operated in consumer credit have probably been close to inquiries through most of their stewardship of portfolios, but it's a capability that for a lot of reasons hasn't existed so much in the MCA and factoring space for, well, ever, as far as I know. What Ocrolus is able to see here is the number of applications or books that come in over time to a unique merchant. So every time we get an application, we resolve that merchant identity. We do so by looking at the bank statement information, as well as business name matching and state and geography. We have we believe a pretty strong unique identifier of businesses, so that we can tell if we've seen them before, when we saw them before, and so we can enrich data outside of the single application in terms of velocity and just a little bit of a trust value. Like, we know this merchant, we may know more about them. So what this is illustrating is that the median, again, the 50th percentile, it rose. So people were applying for credit, or they were at least being processed more often over 2024, became very stable. And there seems to be an uptick in Q2. So the way I think about this, with the 75th percentile, there are those who are always kind of out there constantly in the application process, constantly processing, constantly looking for advances. Maybe a riskier signal, not always the case, but I would say more common risk profile among those. And we see those periodic shoppers who maybe only once a year they look for credit. Both very, very stable. That middle population.
Another interesting thing about this graph, Pat, is that it kind of tells you what's normal. As you said, this is not a typical thing that people have looked at in small business credit, and you might have a sense of what's normal in the consumer world. This gives you a sense of, okay, the median is that people are applying. The time people apply for credit, they may have had, 6 other inquiries over the past 90 days. that would probably be a large number in the consumer world. It's not that large of a number in the business world. And this because people haven't really seen outside of this Ocrolus data credit inquiries in the past for small business, particularly in this sector of the market. This should help to calibrate people's minds as to what's typical.
That was exactly the process I had to recalibrate to, or the information I had to recalibrate to when I started looking at this, because there's a brokerage model that exists too, right? So we don't. I feel like I didn't intuitively have an understanding when I first looked at the data of what is normal, because when somebody has a credit shopping event, when they go looking for credit, they may very well show up 4 or 5 times in the Ocrolus platform just as part of that single shopping event. And so something else we're really excited about is a view where we can deduplicate that over time and get a better view. We say, oh, if we've seen them, but we saw them from another decisioning party yesterday, what are the odds that they went out and applied on 10 different websites versus perhaps be broker referred? And so I think a really interesting way to look at this is in the next exhibit, where we look at, so Oculus can provide 3 data points around inquiries. We can provide that first one I just showed you, which is the number of kind of applications that Oculus has seen across our total platform. And we do it over different time horizons. We were just looking at the 90 days since we're kind of speaking in terms of quarters. But we also have the ability to tell you in an anonymized sense how many organizations have seen that merchant in that time window. And this, I think, dovetails really nicely that we see those who are shopping really wide are shopping even wider, right? It was stable at about 6 organizations over 90 days when they're shopping for credit. And those who are prone to shopping's getting easier than it's ever been. And now they're on average going out to 7. But we see kind of the middle behavior is very, very stable, that when someone is applying for credit, whether it's a intentional action where they are engaging on a different channel or whether it's a broker referral, they'll be seen about 4 times. And I think that's kind of a interesting element that we've all suspected for a very long time. But Oculus has the data and can work with you. This is also a really interesting thing to look at by sector, because you have very, very different behaviors, and by kind of the time on file of the business, which is something that we also receive and are very happy to do deep dives in the future if anybody's trying to understand kind of how all these different comparative measures and cohorts can be used to really understand the business and not just kind of aggregate and chalk it up to mix.
Yeah, another corollary of this that comes to mind is just it gives a sense of the competitive dynamic between lenders and funders, where, you're generally, if you're receiving an application, you're not the only game in town. And so there is a real imperative if you're a lender to make the best risk decision, to have the best product for your customer, to have the best pricing, to make the fastest decision, to have the best customer service. Ultimately, people are able to shop with their feet, people are able to shop with their mice, and people will go to the lender that best meets their needs at the time when they actually need capital.
Yeah, it could be an interesting way to also think about adverse selection, and it's great for comparative metrics. So Ocrolus has benchmarking data available where we say for a particular business and a particular industry or NAIC at different levels of granularity, you can look at it at a NAIC 2 or a NAIC 6, and specific to a geography cohort. So for their state or for their MSA is really the one that we use, kind of think of as a city. How does that application compare to everything else we're seeing? And I think inquiry can be interesting that way too, where you can say, okay, on average, when someone applies, they probably have 4 or 5 other applications out there with 2 or 3 different organizations. Is that normal? How does that compare to all the other SMB applications that Ocrolus sees? And so we can provide that context. We can segment it a lot of different ways, but it can really help you understand what that borrower journey or borrower experience is, and where, at what stage in their credit shopping event they are coming to your firm to make it to have a decision made. This also a very interesting view, kind of going back to Ocrolus's transaction and tagging abilities, which are fundamental to everything we do. But one of the unique abilities or interesting abilities we have is we resolve counterparties on every single transaction where possible or apparent. And what that means is not only do we say it's a fintech or a fintech loan or a bank loan or some other form of loan, we'll also say who we believe that counterparty is and kind of do some cleaning because transaction descriptions can look all different ways and you want to be able to cluster it really nicely. And what this view is showing over time is when someone applies how many existing debt counterparties or how many unique counterparties we can see on transactions that we've identified as credit or debt, particularly for outflows, but we can look at inflows as well. And I think what's changing here, or what stepped out to me is changing, in consumer credit, maybe this goes the other way, is a really prime customer or a lower risk customer is going to have a lot of existing credit relationships in a really healthy place and high availability, low utilization. But on the business side or the SMB side, we don't want to see too many existing debt relationships, right? These aren't lines; these are fixed or non-revolving, and we worry about stacking and we worry about the debt burden building up. And what we're seeing here is that the number of SMB merchants who have more than 3 relationships, that black line, when they come to apply, has crept up a little bit. Again, it's stable, but it's showing that perhaps there are or more products in the market and there's a little bit of diversification in the lending relationships that we're seeing on whole with SMBs applying for credit.
Yeah, and this is just an incredibly important thing to understand when you're evaluating applications, and actually not even just new business applications, when you're actually using cash flow data to monitor existing clients and existing clients' cash flow and use of credit, which I think is an under talked about use of Ocrolus, not under talked about use of cash flow analytics in general. You really want to understand a business's use of credit. Again, very different than use of credit in the consumer world, somewhat more dynamic, more products. And to understand all the different debt counterparties, the different debt products, where someone is in their utilization and payoff cycle with these products, and especially if you see a new debt relationship that didn't exist before for an existing customer, that's a really important signal to reevaluate your assessment of that business's debt capacity.
There are so many wonderful leading indicators in our data and analytics that were traditionally built for origination, right? And you're looking at NSFs, and you're looking at a kind of all the different things that would become knockout rules or that would help you tier and matrix out from an origination standpoint. And I think I've been looking at in the last 6 months a lot is as Ocrolus is building a greater and greater capability around portfolio monitoring, there's such a wealth of data, not just to understand your portfolio and set things like risk appetite and to understand if you have any kind of maybe soft stress testing or conversations happening, you can really get a lot of confidence in the portfolio, or you can identify areas that you can take quick action on, but also from a servicing and monitoring standpoint, collections, renewals. You can just think about how understanding the number of debt counterparties over time on an active agreement, if there is increases in revenue, volatility in revenue or cost, liquidity event or debt events is another really exciting capability where we're starting to recognize the payoff of loans. All of these things that we got a really strong footing on from an underwriting standpoint have just really lent themselves to exciting portfolio management opportunities.
Yeah. All right. Well, as you all can probably tell, Patrick and I can talk about this stuff for hours. We often do. We are very, very deep in this data. And, I always say one of the best parts of my job is getting to talk to our clients about, the way they're growing their businesses, the way they're managing their portfolios, and how they can really use, the best data, the best analytics, the best technology to grow with confidence. So, if you're out there, if you've enjoyed this, please send us a note. We're always happy to talk about these topics, share more data. share more analysis. Hope you have enjoyed this conversation and, visit ocrolus.com to learn more and continue to subscribe to our research.